Good evening. Please come to the last part of this chapter. Change in decommissioning liability. Okay. And the model that the company is following is revaluation model. Yesterday you have seen cost model. So now what will you do in case of revaluation model? Suppose there is a change in liability. So there are two possibilities. The liability may decrease or the liability may increase. If the liability decreases, then there are again two situations we'll discuss. Earlier revaluation is upward. Earlier revaluation is upward means we have a balance in revaluation surplus. Okay. Or we had created the revaluation surplus. And earlier revaluation is downward. Means where we have transferred the earlier revaluation to the profit and loss. So accordingly what they have done, they have given you the accounting treatment. So your note says if the related asset is measured using revaluation model case 1, any decrease in the liability is first compared with the carrying amount had the entity followed cost model. Decrease in liability, one number, compared with the carrying amount had the entity followed the cost model. What would have been the carrying amount? Had the entity followed the cost model? That means calculate the notional value of the asset today if the entity would have followed the cost model. Compare the two. Example, suppose the decrease in liability is 1000 and the notional carrying amount. Why I have written notional carrying amount? If the entity would have followed the cost model, then the carrying amount today would have been 600. Now first you write down these numbers so that you can understand fully. It's better write in a notebook. So your heading would be change in decommissioning liability, and under that your heading would be the related asset is measured using revaluation model. Case 1, write down decrease in liability. Under decrease in liability, situation 1, earlier revalued upward. Decrease in liability is 1000. Notional carrying amount is 600. Situation 1, write down earlier revalued upward. Written. Now see the treatment. A decrease in liability that exceeds the notional carrying amount of the asset. Decrease in liability is 1000 and notional carrying amount is 600. Such excess will be taken to profit or loss and balance will be adjusted against revaluation surplus. So the entry will be now provision for decommissioning expense account debit. Provision for decommissioning expense account debit 1000. Provision for decommissioning expense account debit 1000. Compare the two, 1000 versus 600. Excess amount will be transferred to P&L account. To P&L account 400. To revaluation surplus. To revaluation surplus. $600. To revaluation surplus 600. Up to this 600 rupees will be treated as if it is a deemed revaluation. Right in bracket, deemed revaluation. So this is a revaluation model. So decrease in liability is also again to the entity. So this is deemed revaluation. And excess over and above that P&L account. Situation B, the line is printed in your note that if the decrease in liability is less than the notional carrying amount, then it is fully adjusted against the revaluation surplus. Now write one example for this situation B. Decrease in liability is less than notional carrying amount. Entire amount will be treated as revaluation surplus. So the entry would be this time provision for decommissioning expense account debit 1000 to revaluation surplus 1000. Right in bracket deemed revaluation. So can I just club this 2 point as one? If the decrease in liability is up to the notional carrying amount, then you take it to revaluation surplus, and excess over the notional carrying amount, you take it to the profit and loss account. Now next write down situation 2, earlier revalued downward. Earlier revalued downward. There is a note in the book itself if you don't want to write this sentence. If there had been a revaluation deficit earlier, then the adjustment will be to profit or loss. If there is a revaluation deficit earlier, the adjustment will be to profit or loss. Now write one example. Decrease in liabilities 1000. Decrease in liabilities 1000. And earlier what we had done, amount charged to penal account in earlier revaluation. Amount charged to penal account in earlier revaluation 600. 600. Therefore, provision for entry would be, therefore provision for decommissioning expense will be debited 1000. Where will the credit go? Penal account how much? 600 to the extent charged earlier. And what about the remaining 400? The revaluing 400 will be revaluation surplus. So this will be treated as deemed revaluation. In case of downward revaluation earlier, first you recover the loss that you had charged earlier. Excess over and above that, treat it as a deemed revaluation and credit to revaluation surplus account. So how many situations are over? Revaluation model, decrease in liability. Under that situation 1, situation 2 we have covered. And the last situation which is pending, revaluation model, and there is an increase in liability. Revaluation surplus and there is an increase in liability. This asset was revalued earlier. Now the liability has increased, means liability account will be credited. So which account we will debit? Revaluation reserve. What if the revaluation reserve does not have balance? Then profit and loss. So now in case of this item, write example, increase in liability 1000, balance in revaluation account 600 only. Balance in revaluation account 600 only. So what we will do, journal entry write, revaluation surplus account debit 600, revaluation surplus account debit 600, profit and loss account debit 400, balancing figure. Profit and loss account debit 400, balancing figure, and 2 provision for decommissioning expense 1000. Provision for decommissioning expense 1000. Right. Now there is a case study on this. Come to one question number 70. 70. An entity has a nuclear power plant and a related decommissioning liability. The nuclear power plant started operating on 1st April 20x1. So you underline this date for some calculation purpose like depreciation. The plant has a useful life of 40 years. Its initial cost was 1,20,000. This included an amount of decommissioning cost of 10,000. This included means 1,20,000 includes 10,000, which represented 70,400 in estimated cash flows payable in 40 years. So what is this 10,000? This 10,000 is the present value of 70,400 payable in 40 years, discounted at a risk adjusted rate of 5%. The entity's financial year ends on 31st March. Assume that a market based discounted cash flow valuation of, now what is this market based discounted cash flow valuation of? Means it is the revaluation figure of the asset plant. Assuming that a market based discounted cash flow valuation of rupees 1,15,000 is obtained at March 31, 20x4. So how many years are over? 3 years are over. This is April 1. This is March 31, 2004. And on that day, the fair value of this nuclear power plant is 1,15,000. It includes an allowance of 11,600 for decommissioning cost. Means 1,15,000 is the net amount. Allowance for decommissioning cost 11,600 means what is the gross fair value? Gross fair value 1,15,000 plus 11,600. Keep calculator ready. 1,15,000 and plus 11,600. How much it comes to? 126,600 is the revalued amount. Revaluation figure. Okay. Allowance for 11,600 means this is deducted and this is the net amount, which represents no change in the original estimate after the unwinding of 3 years discount. Student is asking how this 11,600 has come. So 11,600 is the 10,000 into 1.05 to the power 3 because 3 years are over and they have rounded off. Just check how much you are getting. 11,576 the student is getting, rounded off to 11,600, which represents no change in the original estimate after the unwinding of 3 years discount on 31st March 2005. Now this is next year. So first we'll have to understand what entry will pass here and then what entry will pass here. On 31st March 2005, the entity estimates that as a result of technological advances, the present value of the decommissioning liability has decreased by 5,000. The present value of the decommissioning liability has decreased by 5,000. The entity decides that a full revaluation of the asset is needed at 31st March 2005. Again revaluation in order to ensure that the carrying amount does not differ materially from the fair value. So there are two revaluation in this problem. 31st March 2004, 31st March 2005. The asset is now valued at 1,07,000, which is again under net of an allowance for the reduced decommissioning obligation. But this time they have not given you this figure. Student will have to find. Is it right? The student will have to find how much was the decommissioning obligation on this date, and that will give you the gross value of the asset. Okay. How the entity will account for the above changes in decommissioning liability if it adopts the revaluation model. Done. And then you write down, show the balance in asset account and revaluation account and revaluation surplus account on 31st March 20x4 and 31st March 20x5. Okay. So first we'll discuss up to 31st March 2004. This is the question up to. Suppose only this much they ask you. Then this will become one question. Okay. So first let us understand what is the revalued amount of this asset on 31st March 2004. 1,15,000 and plus if I add 11,600, that will give me gross value of the asset. Okay. So write down in your notebook if you want. Step 1. Calculation of revaluation surplus on 31st March 20x4. Right hand side one small rupees column. Compare the book value with the net value. Is it right? So first we'll write down point number A, fair value, net of allowance, for DL. What is DL? Decommissioning liability. Net of allowance for decommissioning liability. In bracket write given. So if you read the problem, they have given in the fifth line 1,15,000. And to that you write add back allowance for DL, decommissioning liability, which is also given in the question in the sixth line 11,600. So therefore gross fair value. In order to find out the revaluation gain, we'll compare with gross fair value. So that is A plus B. A plus B is how much? 126,600. Point number D, we will find out book value on 31st March 2000 x4. Book value on 31st March 2000 x4. Now what is the cost of this nuclear power plant? 1,20,000. And deduct depreciation for 2 years. 1,20,000 divide by 40 years into how many years are over? 3 years are over. I said 3 years are over. To reduce 1,20,000 divided by 40 means 3,000 rupees depreciation every year. Is it 1,11,000? 1,11,000. Point number E, therefore, revaluation surplus C minus D. Revaluation surplus C minus D. How much it comes to? 15,600. 15,600. Now write down balance We have to answer what is the balance in your power plant account, nuclear power plant account. So balance in asset account will be how much? 1,26,600. Two, allowance for or provision for decommissioning liability will be same figure, 11,600. And three, revaluation surplus will be how much? 15,600. Revaluation surplus will be 15,600. Now we'll close this. Come to write 31st March 2015. So we will provide depreciation for 1 year on this asset. This value will change. So next write down step number 2, write down book value of asset on 31st March 2005. First A, write down opening balance 126,600 less depreciation. Now what will be depreciation? 126,600 divided by how many years are remaining? 37. 40 minus 3 you can write, or directly write 37. Round off the last digit. How much depreciation you will provide? 3420. So what is the book value on 31st March 2005 before revaluation adjustment? Before revaluation adjustment. So this is A minus B. Anybody? 123, 180. Okay. Then step 3, write down carrying amount of decommissioning liability. On 31st March 20x5. So first write opening balance. How much was opening balance? 11,600. And to that you add 5% increase. That is your expense. 5% finance cost. 5% is how much? Round off. Make it 600. Round off. So this becomes 11,000, 12,200. Is it right? Now write a note. There is a decrease in decommissioning liability. By what amount the decommissioning liability has reduced? 5,000. Is it right? By rupees 5,000. So what will be the journal entry for this? So now today whatever we have learnt, you have to apply that. Asset is carried at revaluation model because last year we have revalued. There is a decrease in liability. compare the decrease in liability with the notional carrying amount of the asset. The notional carrying amount of the asset today will be 1,20,000 minus depreciation of 4 year, that is 12,000. So it will be just 1,08,000. So the entire decrease in the liability will be adjusted where? Will be adjusted in revaluation surplus. See, I will just go 5 or 6 slides behind to make it clear again for you. We had discussed this situation. There is a decrease in liability. In this example, 5,000. Notional carrying amount in our example will be very high. 1,20,000 minus depreciation for 4 years only. So it will be 1,08,000. So in this case, the entire decrease in liability will be transferred to revaluation surplus account. So this entry which you learned just now will be required now. Come back to that place. So journal entry will be decommissioning liability account debit, 5,000 to revaluation surplus. This is deemed revaluation, 5,000 to revaluation surplus 5,000. Therefore, revised decommissioning liability account balance will be 12,200 minus 5,000, that is 7,200. Now this figure was missing in the question. There is a last 2-3 lines. The asset is now valued at 1,07,000, which is net of an allowance for the reduced decommissioning obligation. And the reduced decommissioning obligation is 7,200. So now we have to again calculate what is the revaluation gain or loss in the second year. Is it right? This you have written? Okay. So next step, write down whatever step number is there. Calculation of revaluation gain or loss in year ended, for the year ended 31st March 20x5. First point number A, fair value net of allowance for decommissioning liability. Fair value net of allowance for decommissioning liability in bracket given. This is 1,07,000 they have given. To that you have to make one adjustment. Add back allowance for decommissioning liability, which is in the previous slide you have written 7,200. So what is the fair value of asset gross? 1,14,200, right? A plus B. And what is the book value? You have calculated earlier. Book value on 31st March 20x5. 123, 180. What was that step number? 2 or 3? Okay, whatever is there in your notebook, right? But you have understood from where I have taken this figure, 123, 180. Now this year, do we have a gain or loss? loss on revaluation. 123,180 is my value and 114,200 is my fair value. So how much is the loss? 8980. And where it will be adjusted? Do we have a sufficient balance in revaluation surplus account? Do we have a sufficient balance in revaluation surplus account? Yes. So will be adjusted against revaluation surplus. See, first year you had a revaluation surplus of 15,600 plus 5,000 you have credited on decrease in liability. So we have 20,600 with us. So we can use 8980 out of that. Okay. Now write down balances of various accounts. This was my question. Balances of various accounts on 31st March 20x5. Right hand side rupees. First point number A, asset. Asset gross value will be 1,14,200. Same. Then allowance for decommissioning liability, or just write decommissioning liability. How much will be decommissioning liability? 7,200. Already calculated this figure. See on the screen again, those who have a doubt. It was 11,600 at the beginning. 600 we added due to 5% unwinding of discount, and then we reduced it by 5,000. So the balance in decommissioning liability will be 7,200. And then point number C, my question was what is the balance in revaluation surplus? So revaluation surplus first year was 15,600. I credited 5,000 and I will adjust 8980 also against it. So how much is the answer? 3,220. Check again. हाँ 11,600. 11,600. Try again. Take your calculator. 15,600 plus 5,000 minus 8980. 11,620. 11,620. 11,620. Please try again. 15,600 plus 5,000 minus 8980. 11,620. But one adjustment we could have done more. What is one more adjustment we could have done? We could have transferred the excess depreciation from revaluation surplus to retained earning. So in that case, the balance will change to that extent. So write one note. The transfer of excess depreciation, due to revaluation from revaluation surplus to retained earning account is ignored. Okay. This answer is over. Okay. Okay, we'll just discuss one more thing. Paragraph 32. Is it 32? Major changes in Ind AS and IAS 16. So almost negligible difference. First difference is in Ind AS 20, if you have received government grant related to fixed asset, related to any asset, there is only one treatment given in the Ind AS 20. You have to credit to deferred income. Whereas in IAS 20, it will be either credited to deferred income or it can be credited to asset account. So actually that we are going to again cover in the IAS 20. And second is that investment property. In Ind AS 40, fair value method is not allowed, but in IAS 40, fair value method is allowed. So that we are going to cover again in that IAS 40. Okay. Now this chapter is over.